Tonight. We have a great panel lineup with experts in the M&A arena. Sitting next to me is Dean Kip Witter. He's the Vice President of the Brenner Group, which provides financial management advice for emerging tech companies and also life science companies. And if you're looking for an interim CEO, or CFO rather, and controller, you would come talk to Kip. The Brenner Group was actually successful in the last 18 months in raising over $80 million for their clients. So for you entrepreneurs out there, I'm sure that's good news. And then sitting next to him on the left, this is Mark Dukas. He's the Managing Director of Eagle Partners in San Francisco. It's an investment bank that caters primarily to mid-range acquisitions, both in technology and in more traditional industries. So if you think just because you're not a tech company that you might not be acquired, well, talk to Mark. He can advise you further on that. And prior to forming Eagle Partners, he was actually a managing director of an M&A group with Bank of America Securities. And we also have Tom Smith. He's from SVB. This is our money man. He provides the debt financing to VC-backed acquisitions. And so he knows all the ins and outs in the due diligence, whether or not the deal is going to go through. So thank you very much to our expert panelists for being here tonight. So Mark, with you being the investment banker, tell us a little bit more about how you get on the acquirer's radar screen to begin with.
Well, is that on? Is that working? No? Okay. Technology. Anybody technical out there? How about now?
Yeah.
No? Is that one working? How about now?
3 times may be a charm.
Well, I'll just talk until we figure out the thing. To get on the radar screen, I would say it obviously depends on your industry. It's working for you.
No? It did, didn't it? Sorry.
I would say there's a couple of things the buyers are looking for. One, and it varies by the situation. One is scale. You have to get beyond a certain level of size to be of interest to people. One is margins. They want to see pretty good margins. And the third is growth. Now you have companies like Skype that sell at very high prices that may not have margins but have growth. You have other companies that have high margins that may not have the growth. So it's any combination of those. How you get on their radar screen, basically that's what we do. People like us represent companies because often companies are in very narrow niches and they often don't want to sell to their direct competitors. They want to reach out beyond that. They're concerned about confidentiality, etc. And so part of our job is to find eligible, capable buyers that are not their direct competitors. They're really just interested in trying to find out information about their customer base or something like that.
Great. Well, we're under the impression that a lot of times what acquirers are looking for is high growth potential. We want to see revenues that are going to be exponential in the years to come. Would you say that's the primary motive of many acquirers in looking for a target?
Again, it varies by situation. Certainly growth is very important to them. If a company is just sort of a very slow grower, the price is going to reflect that. And most acquirers look and say, how can I get my money back for making this acquisition? And growth is usually one of the avenues. Sometimes not. We represented a company that was a distributor of a certain kind of food testing product. And we sold them to a UK company, which had all kinds of products they wanted to distribute in the United States. And they had been distributing through third-party distributors, and they were never satisfied with the service they got, and so they bought this company partly for its own products, but also partly as an avenue for them to take products they already had to distribute through the U.S. customers that they had. So it wasn't necessarily the growth of the target company, it was the established customers, and they could provide the growth by providing their own products.
Great. And Kip, would you like to weigh in on this?
It's on.
It's on?
Yeah.
Oh, wonderful. I don't have a lot to add to that. I come at it more from the nuts and bolts, meaning if you are in a business or a company that is a target, that a buyer, prospective buyer has found you, or you're now looking for a buyer, part of my job is to help you get ready for prime time. So I'm really more in the engine room than I am on the bridge.
Right. And Tom, how about you?
You know, I think very much like Mark said, it varies depending on what the buyer's looking for. You know, we see, especially the technology world, where they may acquire a raw piece of technology, which is a plug-in, or it's looking to open up an adjacent market, or very much like Mark was talking about, you have a U.S. company who's trying to get global reach, and they're going to acquire a service integrator to for software into those markets as well to augment that, or have quicker reach into a country than building it from the ground up.
That makes sense. Now, what if I'm a traditional business? What if I have a great line of designer purses and, there is nothing necessarily original, and maybe I have my trademark, but this isn't a unique IP that Google is going to acquire. What are my chances of being acquired?
I always say there's a buyer out there for every company that has a decent business model. And by decent business model, I mean it has, profits, a sustainable record of profits. It controls its own, destiny to some degree, its own brand. The price may not be as high, something that's more mundane. The price kind of will adjust to any of the variables you're talking about. But if you don't have a brand and you don't have any sort of proprietary aspects of your business and you're sort of a me too, then buyers are going to, it's going to be harder to find them. You're going to have some kind of customer base or something unique that attracts somebody. Otherwise, they say, what do you bring to the party?
Right. And Kip, would you like to weigh in?
I think this area is a little distorted because of the sheer volume of venture-backed companies. So you sit around your board table, you're looking at investors who can't wait for an exit. So don't confuse that with reality. The rest of the world, there are a lot of mom and pop businesses that don't have institutional investors. But eventually, if you've got a founder and the founder's kids are not going into the business, the founder may want to monetize what he or she has built. And that means some form of exit, generally, just finding a buyer.
Right. Now, when we talk about the price that an acquirer is going to pay, and assuming that the acquirer hasn't done a lot of due diligence at this stage, how do they arrive at the value of the company? Where does that number come from? Tom, being the debt finance guru, what are your thoughts?
Why don't we start with Mark, because I think that, to be fair, like Kip and myself, we see the end product after a deal's been struck, or we're working in concert. So Mark, do you want to start?
In my experience, what we do is we prepare an offering memorandum that lays out kind of the story of the company, and it has the historical financials. Sometimes we put in projected financials, sometimes we wait and go over those during discussions, but the buyer's going to look at that and come up with a price based on what they think they can do with the business. So they look at what profits are now in their own mind, which they don't tell you. They make their own adjustments to what they can do to enhance the profits, and then it's sort of a competitive frenzy. We represented a company that was in a very mundane, I mentioned this to Jessica before, it was a garbage company, collection, and they had landfills, 2% growth. They had a locked-in business for years and years. We presented it to everybody in that industry. There's this defined number of strategic buyers. The bids came in and they were clustered. 5 or 6 of them were within 10% of each other. One of them was about 50% higher. And you say to yourself, if people have spreadsheets, they can discount, they can project population growth 2%, they can discount it back. People's discount rates aren't that different. How do you come up with different prices? And at the end of the day, that company just fit perfectly into this buyer's strategic plan, where they wanted to go growth-wise. They were a publicly traded company. Geographically it fit in. So the value, I would say, there's a certain amount of science to it, but at the end of the day, it is there's a little bit of romance to it, that the company just is something that the buyer wants.
The one thing we have seen is within the bank we have a group called SVB Analytics that does 409A work. What we're able to capture though is the underlying fundamentals of the company, where we can scrub away the names and look at cash growth rates, everything else, where as we talk to some larger buyers, when they're looking, gee, what does the universe look like for smaller venture-backed companies? you can give them some form of benchmarking, saying these are the factors we're seeing for growth, you know, cash carry value and everything else. But it goes back to Mark's point. You know, I think a lot of times benchmarking where the market is in comparables, and whether it's a revenue to multiple or EBITDA, you know, is the price.
And financing is very important. We can talk all day long. A lot of our companies have high EBITDA, high cash flow, and we price companies based on multiples of EBITDA. But then a lot of buyers come back and say, that's fine, but how am I going to finance this? Because if the bank looks at it and it doesn't have any hard assets to lend against, it's very hard to finance the deal. So unless you want to put in all equity, that limits how much the price can be. So the assets on the balance sheet do factor into the pricing.
Okay. Kip, do you want to weigh in on financing the deal?
I was going to take a step backwards and encourage anybody that if you are looking to get liquidity out of a business, is do engage a professional, someone who does this for a living, and a 409A valuation, 123R valuation, where you're valuing your equity instruments for stock or stock option accounting. I mean, that's a starting point, that's a data point. But if you have a banker, an investment banker, that's in your corner working for you, the investment banker can give you an idea of what comparables are going for, what recent transactions have gone for, what you might be able to expect, and ideally get multiple buyers. And so there's some kind of a horse race involved, where you're not just trying to negotiate with one person that says, you know what, fine, I'm through bidding against myself, the price is, take it or leave it. I mean, you don't want to be in that position.
Mm-hmm.
The number one competitor to our business of representing people is the do-it-yourselfer. And it's our self-interest, but it's also, I think, a fact that this is an area where do-it-yourself is not advisable. As Kip was saying, you want to have other alternatives. Do-it-yourself deals we see, the entrepreneur, the owners are sort of stuck with one horse, and if that horse falters for whatever reason, they don't have other alternatives. So,
Or if the horse turns on you.
Right, it turns to bite you. So at what point should you begin thinking about the acquisition process? If I'm a company that's been in operations for 6 months, is this too early to start to think about an acquisition as an exit strategy?
well, go ahead.
You've got a venture investor. No, it's never too early. That's because that's at the back of your investors' minds. But if you don't have a venture investor yet, if you've got family and friends money, or if you're a mom and pop business that's not very far along, you need to think about an exit. I mean, death and taxes are the two major certainties in this world, and with the passage of time, you'll encounter both of them. So at some point, and unless your kids are coming into the business and you've got a succession plan in place, that does happen. But even then, I would caution you to get professional advice when you do that. But if you're a non-venture-backed company that does not have a good succession plan, then it may be monetizing is the fairest thing for all your stockholders. And if you're venture-backed, of course we're looking for an exit.
It takes time to get your company kind of ready for sale, and by that I mean it can take a year or more, especially if you have issues, holes, problems you have to address. So I would say it's never too early to start. It's also never too early to kind of know what your valuation range is, because if you kind of have, sometimes we talk to people and they say, I would never sell my company. I had a guy who said, you can tell by looking at me I would never take less than $17 million from my company. And I said, really? How? I couldn't tell that by looking at you, but that was his attitude.
It's 17 fingers.
So you should have, if you're an owner of a business, you should know what it's worth. I think even if you're not really thinking of selling now, so that you kind of have a sense of what the market is. We had a guy once who, he loved growing sales. He was a distributor, so he kept buying up other distributors, borrowing money, and actually the value of his business was going down if you subtracted out the debt, and he figured, well, as long as my sales are going up, the value of my enterprise must be going up. And he didn't like it, but we showed him, no, you're driving the enterprise value down over time, not up.
And Tom, have you seen deals go awry because someone didn't get their financials in order, from the very beginning, and tried to pull together the due diligence just after the LOI got signed?
I think we've all probably seen cases like that. I think Kip's point is doing the proper thing from hiring proper advisors, you know, making sure things are lined up. And as Mark was saying, you know, that there's no surprises in the IP. You know, sometimes with the open source environment, we've seen cases where something popped up and there may be a potential infringement that, you know, blows apart a deal. Or, you know, I think that, you know, as Kip was saying, proper accounting records, if, you know, options haven't been accounted for, and as you're doing the reconciliation, you don't want to be bringing last minute surprises into the deal, because typically that drives the price down, or it can drive a deal away on that side.
Absolutely. Yeah, and from a legal standpoint, that's something that we always advise our clients to do, is from inception really to be thinking about an acquisition, because that will drive the type of business entity that you choose. That's going to help you determine how to keep track of your capitalization structure. Sometimes we have clients come to us and say, well, you know, when we got going, we gave some options to this guy, but things didn't really work out with him, and, you know, we never gave him a stock certificate or anything, and so he's gone now, no problem, right? I said, well, you know, if you get acquired and suddenly your stock becomes valuable, I think he's going to remember who you are. So it's keeping track of these things from the very beginning that will, you know, certainly make due diligence a lot smoother and won't hurt your valuation in the long run.
I think there are two timetables. One, the earlier question said, how soon should I be sort of prepared to think about an exit? And that's kind of long-term. You really should always have a handle on what you think what your company's worth. And I think there's a more focused question that once the decision is made to go find a buyer to sell, how much time does that take? And that, again, that's company dependent. It depends if your acts together or not, depending on, you know, your files, your accounting, and how to present to a potential acquirer, and getting through the due diligence process with as few scars as possible.
Absolutely. Now, speaking about the letter of intent, in this current economic environment, are you seeing terms that are different from, say, the dot-com boom? Are more deals highly leveraged? Are earnouts longer? Are you seeing breakup fees, more holdback, a greater percentage in the holdback basket? What sort of terms can you expect if you're trying to be acquired in this market?
Well, I would say the biggest kind of problem or issue is the prices are not as high as they were a few years ago, in many cases simply because earnings aren't as high. In terms of the structure, generally most of the time we see some combination of normally 70 to 80% cash in a lot of our deals and 20% earnout, or if it's not cash, it's stock. So it depends on what you're accepting. I'm working on now, which is a third cash, a third stock in the other company, which is a private company, and a third earnout. And the earnouts are always very tricky because you have to figure out what metrics, and if you're going to reorganize the company, his company is going to be merged with the other company, so some of his customers are going to be moved around, some of his employees are going to be moved around, and he's not really too sure how to keep track of that with the earnout. We've seen a couple of times where at the end of the day, you simply say, forget the earnout, let's just have a simple formula over time. So in terms of leverage, I think generally, and I'll defer to you, but generally we see banks, you know, want a lot of equity in deals. We see more deals having 40, 50% equity, whereas not that long ago, that was, you know, 20% equity was more normal. So,
you know, I think to Mark's point, you know, we've seen the earnouts play a key component in these deals. You know, typically they want to lock key people up and drive that process as well. You know, some of the interesting things we've seen is, you know, when they get to that point where we've seen earnouts renegotiated as well, because the companies haven't hit the numbers they set. So, you know, I think to Mark's point, you know, in the bank market, we've seen deals, you know, typically more conservative, kind of 2 to 1, and then you see some outer boundaries of 2 1/4. You know, when you get into some of the PE-backed deals, we've seen, you know, deals being pushed out to higher levels. But I think it depends kind of on the underlying asset. If it's a recurring revenue model versus a very lumpy model, a recurring model is much easier to lend into because you've got a level of consistency, and then, you know, the key is the kind of the trailing 12 months EBITDA as you're lending in as well. So and then the synergies between the two, so.
In terms of when you should start thinking about it, we had a guy once who was an entrepreneur, and he hired a number 2 guy maybe 5 years before he wanted to sell. But he knew he wanted to sell eventually, and he knew when he got to that point, he wanted to be able to leave. The earnout was all predicated on the idea to keep the key entrepreneur, owner, you know, if they have the key relationships with customers or suppliers, keep that person economically tied. And sometimes entrepreneurs, the only reason they say, if I'm tied to the business, I want to own it. And if I'm going to not own it, then I don't want to be tied to the business. So what we did in that case was the earnout was structured so that the payments didn't go to the seller. They actually went to his number 2 guy who had no equity prior to that. And this was, the earnout was a way for him to kind of, the seller wanted him to have kind of an economic interest in the sale. The seller wanted to be free of it, and the buyer was happy because they said, well, now this guy who's going to run it has an economic interest to stick around and make things work. So.
Right, and how often do you advise your clients, don't expect the earnout to really be there come 3 years. You know, if you're looking at the price of the deal, it's the price tag that you see that you get on the day of the closing. It's not going to be the earnout that you're waiting for.
Unfortunately, I would say, I always say that, just to be safe. I had one deal in which the earnout, it was about a 2-year earnout, and the company was taken over kind of like halfway through that period, and the new owner wanted to reorganize things. My company was sold to somebody who was then bought by somebody else, and the new owner said, I don't want to deal with this, and he just bought my client out of the earnout rather than have to deal with all the restrictions. But unfortunately, it gets very muddy. And so unless you have a very simple earnout based on revenues or something you can measure, it's easy. But all the earnings-based ones and so on, a lot of stuff can happen. Of course, the economy sometimes, you know, some of the recent earnouts have been torpedoed by the bad economy.
Sure. Yeah, I imagine that's the case. Well, let's talk about, oh, go ahead, Kip.
There's a variation on this theme is if a company sells by doing an asset sale, which is generally end of life for that company. The assets move to the buyer. The employees may or may not move, but the equity stays put, and there's a distribution. There's generally a holdback. I've seen it anywhere from 10% for 1 year up to 50% for 2 years. So that, I think, is the right range. They tend to be 12 to 18 to possibly 24 months, and about a 10 to maybe 20% possible holdback in an asset purchase, because the buyer, this allows him to sit on his cash for a while and smoke out any possible problems with the assets he just bought.
Well, let's talk a little bit about the importance of the letter of intent. Sometimes we have clients come to us and say, well, this thing was non-binding anyway, so we went ahead and signed it, and now can you guys draft the stock purchase agreement for us? What is your response when clients talk to you about the insignificance of the letter of intent?
Well, don't do that, in a word. The letter of intent seems non-binding and it seems very loose, but it has a tendency to lock in some of the terms of the deal, and it's very hard to renegotiate things if you've already negotiated them once. So it's hot, even though clients sometimes hesitate to do it, you should have your lawyer review your letter of intent before you sign it, not after you sign it or like 5 minutes before you're going to sign it.
Right.
I would also recommend to make the letter of intent as precise as you possibly can, because the more wiggle room you leave to be interpreted after the fact, I can guarantee the interpretations between buyer and seller will differ.
Absolutely. So let's talk a little bit more about the due diligence process. So imagine the acquirer is now asking for the boxes of financial statements and the legal documents. I mean, what is the acquirer really looking for in all of this paperwork?
Do you want to start?
Sure. Well, I think really that it sort of operates on 2 levels, at a minimum of 2 levels. On the low level, there's a checklist. They want to see that all of your ducks are in a row, your accounting is proper, you haven't misplaced any stock options, that all this, the documents supporting your cap table are there, everything's properly dated, properly signed. all the employee invention agreements are signed and dated appropriately, that there are no holes there. So, and that's a battle of checklists, that if you're an early stage company, you're going to get an A-round checklist that differs radically from a later stage company that's either doing a complete sale or a later stage or an IPO. That's a much more elaborate checklist. But at the higher level, you are actually presenting yourself to your buyer, warts and all, and the buyer is going to look at this coming into the due diligence process. If it goes smoothly and you're buttoned up, meaning these things are as you said they were, the buyer's going to get a warmer feeling. But maybe I'll turn that around. If there's some huge gap between what you've said and what the documents show, that's going to raise an ugly specter of doubt. And I think I was talking to Christopher before the meeting, and Christopher was on the buy side before he actually sold the company last year, he told me. But he said on the buy side, he could go in and he would know in a very short period of time whether his company was going to buy the company on whom they were doing due diligence. So it's a question of impressing and putting your best foot forward, impressing your buyer.
One thing we see clients be concerned about is their customer list and the names of their customer list and how much business they're doing with different customers. And most times I've been experienced, we prepare the exhibits with all the data, but not the names. So we say customer A, B, C, D, and E. You can see what our terms are with those, and we will show you the names of the customer when we're sort of down at the kind of the last, once the contract's been agreed to. Because usually due diligence starts at a time when you're still in the process of going from the letter of intent to an actual contract, which can, the deal can blow up at that point, and sometimes does, but there's still a fair amount of time between the letter of intent to closing. But due diligence is a big deal. It's particularly if you're selling to a publicly traded company, they're very sensitive about having complete information, and smaller companies sometimes don't have complete information, and there's kind of a heavy load on smaller companies to come up with it to satisfy the buyer, and also the lenders want to see that they have all their agreements signed. You wouldn't believe how many times people have agreements and there's not a signed version anywhere.
Yeah, we encounter that a lot too.
I think the other thing, just following the theme Mark was talking about, especially with a competitor where they get into the knitting, they're doing customer contact as well, and then a deal comes apart. That's a risk element, as you step into these as well. But I think to Mark's point, when we see some of the larger acquisitions, they'll send their team of lawyers in, to Kip's point, to do an IP review. They may send accountants in to do a quality of earnings report as well, to blow apart the financials, say, okay, if this was a publicly traded company and we're going to fold this into another publicly traded company, what level of public costs can we remove? What level of restructuring can we do to get benefit for EBITDA add back during the first 90-day period? But I think the common theme here is the cleaner the books are and hire professionals, because this is, once you get into it, it is a legal gauntlet you run as you go through this process, and you want to make sure the ducks are lined up.
I'd also counsel that if you're a small company, it's a very time-consuming process, and to the point of getting people in that know what they're doing to help you, that leaves you as the CEO free to run the business while you're in this stasis, while you're being evaluated. And it's very tough. It's a very tough balancing act for an executive to manage. Be on call, and they get a call from the buyer saying, show me this, or this isn't right. Ideally, you'd like somebody that knows everything in the data room, that can take all those calls and deal with 90% of them. That takes it off of the executive's plate, frees the executive up to run the business.
I'd also say we advise people, if you have warts in your business, come clean with them earlier rather than later. Because if a buyer discovers something during due diligence, it gives them the impression that, well, okay, I found this, but maybe this is one of half a dozen other things which are somewhere that I didn't find.
So what else have you not told me?
Right.
So if you have something wrong, and everybody has problems somewhere in their company, we always advise put that up front so that when they do the due diligence, everything good or bad, is consistent with what you told them before.
Right, no surprises. And Tom, you had raised the point about IP, and this is something that we also advise our clients on from a legal standpoint, is if you have licensing agreements and you want to protect your IP, be very careful about these definitions of derivative works and source code escrows, and you want to make sure that anyone that you're licensing your IP out to is not going to be able to take it and run with it and bundle it with all kinds of different IP and leave you holding the bag as to what you actually own and what you don't. So be very careful. Don't go out and grab one of these agreements that are right off the web and think it's going to work just fine as a licensing agreement. You want to make sure that you retain full ownership over your IP and that it's very clear what your licensee can and can't do with it. So,
and I would just add to that, employees too. We had a deal in which the employee had developed some software, and there was some ambiguity in his employment contract whether he retained rights to it or the company did. It was not a very well crafted, and so he obviously, it turned out that it was very important software, and he held up the deal at the last minute and said, well, if you want me to sign this release, I will, but here's the price.
Right. Exactly. So in speaking about red flags that come up during due diligence, what are sort of the main red flags that would send an acquirer running, or at least cause you to take a substantial haircut on the price that you were expecting to get?
Well, we had one which, we had a guy where the EPA was conducting an investigation, and that scared the buyer, and the buyer said, well, we'll do the deal, but we'll put 50% of the proceeds in escrow pending the resolution of this EPA investigation. And it was one of these kind of whistleblower lawsuits that where somebody had written a letter saying this company had done certain things wrong, and the whistleblower gets a multiple of the damages, so they have an incentive, and these, and so there was some reason to doubt whether anything had been done wrong, and so that was, in that case, our client took their company off the market. They said, I'm not going to take this deal 50% holdback. They waited until the EPA investigation was resolved before they did it. So I would say anything like that that raises so much doubt, you have to rethink your process.
Absolutely.
That's on the accounting side, things like revenue recognition, if you're not doing that right, and the buyer comes in, particularly if it's a public company, you're not doing your revenue recognition right, therefore your earnings are not being properly reported. Guess what? You're not understating them, I guarantee you, you're overstating them. So we're going to put our own fix on that, and now I've got to look at the rest of your accounting. I'm not so sure about the rest of this. That are you amortizing stuff correctly? Does it just raise a bunch of questions? Tax compliance? I mean, if you've got a tax audit, again, if it's, tell him up front, because he's going to find it out.
Right.
We had a guy who had a bookkeeper. He didn't actually have an auditor, and we recommended he hire an auditor. He grumbled. He said, I don't want to spend the money for it. He eventually did, and as a side benefit, or maybe it's not a benefit, but anyway, they discovered that somebody was stealing money from him, had been embezzling money from him for years. So, at least he found that out. It kind of covered the cost of his auditor.
Right. Tom, what are your thoughts? I mean, in reviewing the due diligence and taking a critical look at it, what are red flags for you?
Well, I think like Mark was saying, we've seen things like FPCA investigations where all of a sudden you've got an issue and it can't be quantified on what the potential outflow is. So you're going into a situation where you could have a huge outflow of cash and you can't box that. So either it's going to be a huge holdback to address that situation, which you're going to get a discount. So things of that nature, you're looking, or is there material contracts which have a potential not to roll, versus a recurring model where you get a steady eddy stream of revenue, or is it lumpy? Or is there a large customer concentration which was 90% of revenue that could go away? Or, I think to your point, Jessica, have they structured an agreement which is tantamount to an exclusive license? So it's a sale, versus the treatment. So, I think a lot of these things that almost like the buyers going in, the bankers gonna do that level of work too, saying, okay, where is the risk, and how do we try to de-risk this as best we can?
I just wanted to comment briefly on customer concentration, because we had a company that did work for Boeing, and Boeing was about 75% of their business, and they did such a great job that Boeing kept doing more and more business with them, and their customer concentration kept going up. And they said, well, that's a good sign, because they love us so much, and it's very hard for buyers, especially financial buyers, private equity buyers. It's easier for a strategic buyer to accommodate that, but a financial buyer that's looking for financing, too high of a customer concentration, which I would say, if your top 2 or 3 customers are more than 75% of your business, that's a real red flag for buyers. And you can say all day long, we have a long relationship, we love them, but especially here in the Valley, there have been a lot of instances where people are too tied to one customer, and then one day the customer comes in and says, we found somebody, a little cheaper, you're cut off.
Right.
So that's a red flag.
In terms of getting your financials buttoned up, how important are GAAP standards? I mean, if I'm a small company, I have an outside accountant, I haven't really thought about complying with GAAP. Is that critical for going into the due diligence process?
Well, the bigger your buyer, the more important that's going to be. If you look at merging or getting acquired by a company your size, about the same level of maturity, maybe not so much. But a lot of times I've seen small companies where there's, I've got an outside accounting firm. Well, yes you do, but they're preparing your tax returns. So what you're getting are compiled financial statements, no footnotes, and they're done according to income tax law, not GAAP. So any buyer who is on GAAP, either a public reporting company or one that would like to be, is going to look at your balance sheet and your income statement, and they're going to convert it to GAAP. To say, how would this look in my financials? And it's going to look different from the way you think it does.
Mm-hmm.
In the course of what we do, we also prepare adjusted financials, which are not GAAP, but it takes whatever the company does produce, it has to tie to what they produce, but it makes adjustments because there's all kinds of things, some of which are very, buyers accept that they're very legitimate, like, rent is unusually high or low for one reason or another, or we are spending money on a new product line that hasn't paid off yet, or there's different things you can identify that aren't GAAP that buyers will accept, and it's actually helpful information. And as long as it ties back to something that the accounting firm will sign off on, and you can just specify it.
So in terms of relying on financials, let's talk about projections. Going back to the first company analogy, so I've grown twice my size within a year. I expect to grow by another third next year. And heck, in 5 years, I'm going to be doing $100 million in revenue. What sort of financials are you looking for me to back up those projections?
So, we'll go a couple of ways. I always think that, we'll look at the buyers and their history as well. So, how consistent is the top line growth? And, but really it's the cash flow, when we look for repayment. If they're buying a company where it's been inconsistent, you're going to haircut that as you integrate it. Because, I think we find with a lot of these acquisitions is people think they'll get synergies and lift quicker. Usually it takes longer than people thought. So when we run our models internally, we're going to haircut those and sensitize it down, saying, okay, when we run the covenant levels, where do they break? If the lift doesn't come, or the step ups over time. If you get a buyer with a strong one, you may discount the buyer if it's inconsistent, saying, well, if they don't get the lift, could they service it on their own? The other thing is we meld the models together, and we see this a lot more with the PE firms, to Mark's point, is with the quality of earnings. If it's a carve-out, say, of a public they're bringing in, they may not have financials for those. So the quality of earnings will kind of recreate what that looks like, lifting the burden of overhead out. If there was stock comp add backs, depreciation, amortization, where we're bringing those in. Or if they're buying another public, you get an automatic lift of, say, $1 million, $1.5 million from removing the publicly traded costs, duplicative audit, duplicative insurance, things of that nature as you go through. So you start to deconstruct it and look where the risk is, Jessica.
Projections, I would say, that's a little bit of a dicey proposition if you provide projections, because if the projections are super aggressive and attractive, buyers say, well, why don't you just hang on, you know, a year or two and make these real, and you can get a price based upon this higher level of earnings and sales. So if it's, they kind of are skeptical. The other thing that happens is they will say it's very typical, there'll be a gap between what the bidder offers and what the seller wants, and the buyer will often say, well, let's try a payment here based on these projections we have. They're very convenient here, and if you attain these projections, then we will deliver on the rest of the purchase price. So if you have, you know, got these tremendously high projections to entice somebody to be interested in your company, it can come back to bite you if it turns out that you know they're completely, you know, unrealistic. So we're always trying to keep them within the bounds of plausibility.
Yeah, that certainly makes sense.
And I think, aside from looking at those items, if you're going back to the first company analogy, the buyer's going to look at what experience does this company have in growing revenues? Is it staffed to increase the business? How many salespeople does it have? Does it have a marketing group? Does it have a marketing mind? Does it have a marketing plan? Just to show me how you're going to go from 1x to 100x in 5 years.
I think the other thing when you look at these companies is the capital intensity as well. You know, when you're deconstructing a company which has a large capital intensity, you're going to look at their maintenance capital levels, and then there's always the success phase. To Kip's point, you know, how do you grow the business? So, you know, with a software business, typically, you know, with the SaaS model, you've probably got some level of CapEx, you know, with a data center as you build it, but, you know, they're probably less CapEx intensive in some industries as well. So that kind of plays in when we're looking at the financial projections.
And we talked a little bit about companies realizing, because of a particular problem, that they're not going to be able to get the valuation from an acquirer that they want. Are there other instances when you advise the company, look, it's too early for you to go out and try to market yourselves to acquirers. You should be looking into trying to grow either by raising funding or trying to meet these projections that you claim that you'll reach. In which instances do you advise clients to hold out on shopping around for an acquirer?
Well, it all depends. I mean, one scenario is that if somebody has a new product or something that's kind of very near term, I mean, my advice is give it, I mean, it's a double-edged sword. But if it really seems like it's highly likely to pay off, I say wait and get some traction under that so it's not all speculative. Because people will discount it if it's speculative, but if it has some proven track record, even if it's not too long, but real track record, I would say they'll get much more value for it. So if they're real, but if they're, on the other hand, if they're just developing something and it's still in the kind of the tinkering stage, then I would say don't wait for that. But anyway, so new product would be one reason I would say wait. Management would be another one. We like to have some continuity of management, and it's harder to sell a business if there's nobody there. So another reason would be if you have a real hole in your management structure, I would say wait until you can get that hole fixed.
Yeah. And what about particular red flags, like in the financials? Is it something that could be fixable, that you could deal with, and then wait to shop the company around until you've got some of these serious red flags addressed?
Things like a Foreign Corrupt Practice Act violation, that might be a tough one to fix. But if it's how you're doing your accounting, how you're presenting it, your reporting, that, if you can make your changeover, survive it, and then get on to 2 or 3 or 4 or 6 quarters of just, you know, predictable, I mean, that is the results are as you said they were going to be, then you can go back. So a lot of the finance and accounting issues are fixable. They made it a little settling time. But then you've got a couple of showstoppers, which, you know, better to know about those early rather than late. And I mean, then you'd have to walk away from the deal.
Sometimes taxes come up. The seller is going to indemnify the buyer for any tax liability. So we've had people where there's a, you know, they may be having an audit or some sort of dispute with the IRS, and the buyer will say, I don't care, you're going to fully indemnify me for any kind of tax issues prior to the close. Now, How good is that identification is another question, and so they may, if it's really bad, require an escrow or some other security, because they really don't want to be bitten by any, or litigation or anything prior to the close. So it's always a good idea to try and solve that kind of stuff if you can, but in real life, it's not always possible.
Yeah, absolutely. I know from a legal standpoint that when we represented a buyer that was a publicly traded company in Europe that wanted to acquire, even just in an asset purchase, a company here in the Bay Area, they had two pieces of litigation going on that were very expensive. And it wasn't likely that this litigation was going to follow with the asset purchase, but just because it was going on was such a huge red flag. We had to advise the clients that you probably don't want to run the risk of these plaintiffs coming after you once they find out that you basically gutted the company. So having settled litigation prior to going out and shopping your company around is probably a good idea. Well, let's take an example of a small company that's, everything's been going great, we've been growing, we don't have any legal problems. We've had our accountant that has always been in the family, we've known him for years, and now we've been approached out of the blue. An acquirer wants to pick us up. So what value would you add as an investment banker, Mark, to this scenario?
Well, we actually had a funny situation in which we were talking to a potential client. It was a ski resort, and were being pursued by a buyer, and the buyer put some money on the table, and the client started talking about hiring us, and the buyer said, don't hire anybody, I'll increase my price to X. So we added value. We didn't even get hired. We added value just by being a threat. I would say, there's people like what we do. We add value more in terms of having multiple buyers and basically giving you a process which gives you a lot of choices and a lot of options. But if you're approached by one buyer and you like that buyer and you want to do the deal with it, you can still hire, your attorney can do it, but the price that you negotiate and what you end up with are not necessarily the same thing. And there's a lot of work that happens in drafting the contract, setting the reps and warranties, and doing the whole legal documentation, even after you've agreed on the price, that can make a material difference to the value of the deal. So I would say sometimes it would be somebody like us that could help you if you really, but more often somebody like us is helpful when you want to talk to a wide range of people.
Absolutely. And what about from an accounting standpoint? I mean, it seems like we've been keeping accurate records. Am I doing anything wrong?
Well, you don't want to find out the hard way. I think to the earlier point, you're running a business, whether you're in the purse business or the software business, your business is not buying and selling companies. So you're going to do a purchase or a sale episodically, meaning you don't have a big reservoir of expertise. It argues really to bring people in on your side that do this for a living. They see it on a daily basis. It will assure you on the banking side of getting kind of the widest possible showing and then the best possible price available at the time. And as far as using the brother-in-law Sid to do the accounting, you ought to have somebody come in and take a look, at least over his shoulders, just saying, are you ready for prime time? Will this pass muster?
Yeah.
Just to get the advice, just so you know.
We had a case once, a guy who was in the insurance, third-party administrative insurance claims, and he was approached by another guy in his industry, and they hired us because our client just hated this guy. He liked the idea of putting his company together with their company. It made a lot of sense from the business point of view, but two of them had been competitors, arch rivals, and they both had big personalities, and they just couldn't deal with each other. And in that case, all he wanted us to do was sort of be an intermediary, a buffer, so that the two of them didn't get into fights just because of their past history. So there's lots of reasons and that was one in which ultimately the two of them did not go together. He only wanted us to talk to one buyer. The two of them did not make a deal. Then he hired us to find another buyer, and he said the deal we made with him was our fee was 0 if we didn't if the price we got was the same as what they offered at the table, we would get 10% of anything above what was on the table. And we got him $10 million more, so we had a $1 million fee. And at the end of the day, he said, "Gee, this seems like a very big fee. I don't know why I agreed to that."
Right. Absolutely. Yeah, I mean, the same is true from a legal standpoint. You know, we had a client once say, you know, everything is going great. You know, we haven't had any litigation. Our employees are perfectly happy. We just wanted you to take a look at the books. And he had bought one of those incorporation kits, and he paid a lot of money for it. It was like $700, but it was really just very expensive Xerox copies. And I went through it and I said, well, you do have articles of incorporation, but nobody owns your company. You never issued shares. So sometimes these things come out, and you certainly don't want them to come out during the due diligence process. Well, if our experts could give 3 sentences of advice to would-be acquired companies, what would those 3 sentences be?
3 each or 1 each?
You can go for the full 3 if you like.
Well, my 2 thoughts is allow plenty of time and hire pros. Get the best you can afford on your side to help you with a deal.
Great.
I think those are excellent. I would 100% agree with those. I would allow, it's an emotional process, which is the one thing I think people don't always, you think most transactions are financial and strategic. It's also emotional, and I think a lot of what we see is, especially if you own a company yourself, getting over the hurdle of, this is my identity, this is my life, and separate yourself from the business. Most people we represent are much happier. They love running their businesses, but they're equally happy being free of them. I mean, the business can drive you crazy sometimes too. So my advice would be, I would say, have management, have a successor management in place, to address customer concentration, and address, if you can, get financials, get good financials, and clean up your facility. If you have a facility, spend the time to clean up everything, your books and your records, and also your physical plant. I had a company once had a very bad physical plant, and he moved, and then all of a sudden the buyers liked his company a lot better. The financials were the same, the business was the same, but it was just in a different facility.
You know, I think one of the points Kip raised earlier is valuable when you get into this build a data room, you know, and populate it ahead of time. Because as you get into this, it's a time sink, you're going to be pulled away. It's a way of directing people to run the process. I think the one thing that, you know, as buyers go out as well is the cultural fit when you're buying these companies. Sometimes, you know, everything looks good, but it's the culture when you push 2 of these companies together, especially if it's a different country, you know, the way they look at it, where key engineers are overseas. Are they in sync with the path as well? Sometimes we've seen divergent views there.
Great. Well, are there questions in the audience? Yes.
What business structure is better or doesn't matter? I'm talking about the level of corporation versus LLC.
Well, if you're talking about VC funding or being acquired by a larger entity, not just, say, a sole proprietor acquiring another sole proprietor, then VCs and larger acquirers definitely tend to prefer Delaware C Corps. Almost all large investors don't like any type of pass-through entity because they don't want the tax consequences that come along with that. It just gets too messy.
Are there actually, the reason I brought up this question was that I'd read somewhere, and I don't know if it's true, which is why I'm asking it, that there was a huge tax difference in selling a company that's incorporated as an LLC versus a C corporation.
Yeah, so with the C Corp, the taxation is actually double. So the C Corp recognizes the tax, and then as you make the distributions to the shareholders, there's yet another tax consequence. Whereas an LLC is purely pass-through. So everyone that's an owner of the LLC gets the immediate tax consequence as if they were just earning ordinary income. Any other compelling questions or remarks?
You can get into a lot of complication if you're selling stock, or you're selling assets, you're selling S Corp stock, or C Corp stock, or LLC. working on one now that's a sole proprietorship. You can't do mergers in certain circumstances. If you have, and it also varies by state. So I guess the answer is there's no perfect structure. The C Corp is the traditional one. However, it is, from a tax point of view, it makes it much harder to sell assets, and buyers often prefer to buy assets, especially if they're worried about what other hair comes along with the C Corp that they don't want to deal with.
But you'll also get an adjustment to when a pass-through entity is purchased, the buyer's going to try to render it in a form that makes it look like a C Corp. So there's going to be a tax provision, deferred taxes, things like that would never be there on a pass-through, but they're going to craft that kind of momentary balance sheet and a revised P&L to have a tax provision.
And if you formed a particular entity, you're not necessarily married to it for life. You can convert it. Now, you can't keep converting it too quickly in a short period of time. You usually have to wait. If you decided to be a C Corp when you were an S Corp, there's a window of time before you can convert back again. But it is possible to convert. It gets a little bit complicated between corporations and LLCs, but it's possible to do.
I would not use an S Corp. There are restrictions on who can be your shareholders that may preclude your perfect buyer from buying it. You have to jump through a hoop to reincorporate as another entity.
So like C Corp versus LLC kind of just depends. Then there's not clearly one better than the other.
Well, it depends who you're trying to raise financing from and who you think your potential acquirer might be. I'd say the vast majority of our clients are Delaware C Corps. It's just the traditional model. It seems to raise the fewest questions. And then you also don't run into problems like with option plans. You can have option plans if you're an LLC, for example, with your employees, but it's just not something that's traditional. So if potential buyers are coming in or investors and they see a stock option plan, they say, okay, I know what that is. That looks familiar. But if they see an LLC option plan, they're kind of like, okay, so does this work like a stock option plan? These kinds of questions are raised in their minds, and that's not so much the case with the C Corp.
And since we're talking about taxes, I just want to put an ad in. When's the best time to sell your company? This year, we currently have capital gains rates of 15%. You've heard of, how that's gotten part of the press of the campaign right now. But that's supposedly going to expire at the end of this year. We don't know, but Washington's looking for a lot more revenue.
So Sacramento.
Okay, so Sacramento. So taxes do play a big factor. The transaction you're talking about where you get taxed twice, that's where a C Corp sells its assets. The C Corp pays a tax on the sale of the assets, then it liquidates, distributes its money to the shareholders, and they pay a tax too, so it's double tax. That's usually a fatal outcome. You have to find another way around it.
Yes, this is true. The tax consequences always have to be considered as well.
Thanks.
Other burning questions? Yes?
So in your career, have you ever advised a venture-backed company to make the merger and acquisition deal happen later?
So I think that'd be a question for you, Tom, in working with VC-backed ventures.
We really don't give advice from the banking side. I think a lot of times, Kip and Mark can probably speak to this. For the VC-backed company, you've got the oversight of the investors who typically kind of decide, look, as Kip was talking about, we're looking for liquidity, and and then engaging bankers. Kip, Mark, is that fair?
Yeah, I think on the investor side, they're trying to balance, are we going to run out of money? That would be a bad thing. Or if we can continue on and hit some valuation milestones. But I think that if you've got a venture board, they'll have done that exercise.
Yeah, that's been my experience. If you have a venture capital firm, a traditional venture capital firm, they have a lifespan to their partnership, and they generally reach a point where they start giving you very strong messages that now is the time. Whether it's the right time for you. We had a company we worked with which had, it was actually distributed by the venture capital fund to the investors in the fund because the fund had reached the end of that term. And then it was kind of good news, bad news. The investors were all kind of amorphous. They didn't have any particular representative. Some of them wanted to sell sooner, some of them wanted to sell later. It was, they wanted some cash flow. So, I mean, the fact is, a venture capital partnership is intended to attain liquidity in a relatively, finite amount of time. So we don't really advise them. We basically listen to what the owners want to do, and that's dictated by, their own timetable.
And, to Mark's point, what we've seen recently is transactions where they're coming to end of life and you get people with fresh funds who are, taking those people out and the company continues on versus, taking an exit, to Mark's point, saying, gee, we don't think we've realized full potential. This party is looking for an exit, another one's prepared to take a position and deliver more capital to grow it out.
Yeah, and these years there are actually specialized secondary funds just to buy this, non-exited like portfolio companies.
It varies, the buyers. We've seen PE people come in, if they're looking to use it as a platform for further acquisitions or grow it quicker or buy out a competitor as well. We've seen a number of those recently where it's end of life and they're saying, look, we'd like you to tack on acquisitions and you're kind of a platform we want to use to go out and make that.
Thank you, guys.
Any other questions? Yes.
Can you give us a little wisdom on breakup fees with regard to LOIs and let you know a little bit more about best practices with that topic?
So the question was a little more wisdom on LOIs and the breakup fees, and I'm sorry, the last part of your question?
No, just on that topic.
In the smaller deals, I very rarely see breakup fees. The typical scenario that I deal with is both sides bear their own expenses, which is usually significant between what you pay your advisors, your accountants, your attorney. You see the big deals where they will have like AT&T, the deal just blew up and they have, I think it's $1.5 billion breakup fee, and they have to give some spectrum back. So on larger deals, they do happen. They're hard to collect on the smaller deals too. So I would generally, it's not very typical that I see them. People talk about them, but usually, in my experience, they don't actually include them. They do it, the LOI will have exclusivity. So a typical LOI would say you take your company off the market for X period, and that's sort of enough to keep the buyer happy.
Yeah. Yeah, we hear about a lot of clients asking for breakup fees, but whether or not you get them is another issue. Yes?
Can I just ask, going along with that exclusivity, my understanding is that when you take yourself off the market, that doesn't preclude someone from approaching you, correct?
Typically, in a publicly traded company, you can never say you won't listen to reasonable people that come along. Privately held companies, generally it's drafted so that you won't provide them any information, you won't talk to them, you won't do anything. So it's a pretty strong preclusion from talking to anybody. And again, selling your company is a lot of trust. You're trying to build trust between the other. So if you sign an LOI with somebody and you go behind their back and talk to somebody else, you're really, I would say, not helping yourself. I think you're hurting yourself because you're sort of likely to lose the first horse and you don't even know how good the second horse is. So I would say don't sign the LOI, rather if you have, some other people floating around. The exclusivity, we always say, the exclusivity is in place, we abide by it. But it usually has a time limit. So you can say 60 days, 90 days, however long it is. Once that time is up, then you're free to do whatever you're going to do.
Yeah, and certainly having a shorter exclusivity, if you're the seller, is better because that puts more pressure on the buyer to commit to other terms that you want before you get out there and start shopping your company around again. Yes?
If you remember, there was a case with a multi-billion acquisition of Skype some time ago, and by some reason the founders of Skype could save their IP that was critical for Skype to work, and then it appears that they still could get some part of the equity back to them just to let use their IP. How could this happen in terms of the multi-billion acquisition? was it a mistake in due diligence process, so how founders could do that? I mean, it was a really big deal, and that's a very interesting issue. So what do you think about it?
I don't know the specifics, but it's a due diligence question as to who owns the IP. And something like that, where it sounds like the company didn't really own the IP, but the individuals did, you know, that's a pretty big issue. And you should have made, somebody, I don't know whether that was when eBay bought it or when Microsoft bought it or which iteration of Skype.
It was previous one, not Microsoft, eBay, and Silver Lake and other funds.
Yeah, I don't know the specifics, but yeah, the only thing I could guess would be that they retained certain IP personally and didn't just, you know, and it wasn't either discovered or disclosed or something right up front.
You know, we had an interesting case with one of our publicly traded companies. They had sold the division in the IP that went along with it. And it was interesting, they were starting to follow a strategy to do something else. And this buyer realized, I guess, an opportunity to have a little more reach into the IP. And for them to strike that deal, they had to make this other one go away by cross-licensing. So sometimes it's leverage in the market. I think, you know, IP is important, you know, especially in the mobile world right now where you see that leverage effect. So, you know, sometimes it's negotiation in behind, you know, from previous deals struck, people trying to enhance the position. So, you know, I think it goes back to the earlier theme that Kip and Mark were talking about, was the diligence and the proper accounting for IP for these, so these things don't come back to bite you.
Yeah, and that's true also of the IP assignment agreements that you're going to have your employees sign. So, you know, we've done the legal due diligence for companies and seen these beautifully drafted employment agreements and IP assignment, and they're not signed. And, you know, they just gave them to the employees, but nobody ever went back to track them down to make sure the employees had signed these. You know, the same can be true also with licensing agreements. I mean, if you are providing a source code escrow in the event that you breach any term of your IP agreement, well, then you're giving your licensee the opportunity to reach in there and get the source code and perhaps develop it to compete with you. So you've got to be very careful about the documentation you have to protect your IP. So I suspect it was something along those lines, that there was some type of IP assignment agreement that was never presented to someone within the company, or they just didn't sign it. And then once they realized how valuable it was, they were saying, aha, okay, I have an ownership interest in that.
Yeah, it was probably something that slipped through on diligence. I don't know any of the facts, but the last line of defense are the reps and warranties in the actual agreement, where the seller may be asked to represent that everything is scheduled, they free and clear title to, and that's what's being sold. So if they have to go do battle with the founders who claim that they own the intellectual property, the buyer's got a claim against the selling company for a breach of rep, breach of warranty.
Right, so as the buyer, that's when you'd want a big escrow, so that you have money to go back to deal with these claims. Otherwise, the shareholders that you just paid out may all be in the Bahamas and nowhere else to be found.
No extradition treaty. I'm going.
Right.
The sales contract typically has a clause saying that you, the seller, have disclosed to us, the buyer, everything of a material nature. You have not failed to disclose something, even if we didn't ask about it, that would be material. It's a very broad, sweeping language, so you can't really say, well, nobody asked me about X, Y, or Z. The seller's still on the hook for that. And the IP thing, I just want to add a comment. Usually, and it makes sense, you want to nail down all your IP and be very meticulous, because something you don't think is very important right now is that's the best time to get somebody to sign the release and do it. Don't wait until you discover years later, oh my gosh, this little invention that we never thought was important has become, you know, crucial. We see that all the time, and somebody said, well, we didn't really pay attention to that, and you have much less, you know, leverage with this, whoever the other side is, once everybody knows how important it is.
Absolutely. Yes?
Yeah, so let's say in a startup environment, if you have, let's say, multiple founders, let's say 3 guys, and there is a buyer, good proposition, 2 of the founders agree that go ahead and let's sell the company, but one founder says, no, I don't like this deal. How does this affect on the quality of the deal? When there's a disagreement between the founders as far as like if this is a good deal or not?
This happens all the time, and it happens in families. We see this in families where you'll have 2 brothers like the deal and one brother doesn't, or the husband likes it and the wife doesn't, or your situation, 2 founders like it. I guess ideally, and Jessica can comment, ideally we like to have some sort of arrangement between the shareholders so that you can resolve this kind of thing, because otherwise it's just a standoff. You can't resolve it. But if you have an agreement in place where you can buy each other out, you have a buy-sell agreement, or some sort of way to get rid of an intransigent seller who doesn't want to sell. Otherwise, nobody wants to buy 2/3 of a company and have 1/3 owned by some, you know, yeah, some jerk. Well, yeah, okay. So it could basically stop the deal if you have no way of bringing that guy's shares in, because, you know, owning 2/3 of a company is not anybody's going to go along with it.
Yeah, and this is why it's very important from the beginning of your company's inception to have the right type of stock purchase agreements in place, because you want to make sure you have right of first refusal terms in there in case you've got a shareholder that starts to run amok, and maybe they want to go out and sell their shares to somebody else, or you know they start competing with you, that they can't transfer that interest to any third party without first offering those shares back to the company or to the other shareholders. So that's a way that you can keep tabs on the ownership. But just as Mark suggested, that's usually the way that it's dealt with. If you have a minority shareholder that doesn't like the deal, there is some price that they probably will take from the other shareholders to get out from under them, and you can do the deal that way. But it's got to be buttoned up from the very beginning, because I've seen situations where a shareholder goes out and they try to, they get into a hostile situation with the company and they want to sell the shares to a competitor, or they just start to make things messy. So make sure you can keep tabs on them before you're acquired or go public.
Yeah, those situations, from my experience, lead to litigation and sort of everybody losing. And aside from that, bitter feelings. And so then you're not disclosing. There's questions about who's getting what information, and one person feels they're not getting the same information. It just becomes a mess. I had one, we were hired to sell a company, and I didn't realize that when we got hired, it was a husband and wife, and I didn't know they were in the process of getting a divorce. And so in the course of the deal, they started fighting so much, because that was their main asset, was the company, and they fought over it. They couldn't agree to anything, and ultimately various things happened in their industry, and the company went from being worth a significant amount of money to being worth nothing. So it was too bad, but you know, that's what happened.
Yes?
So 2012, from a deal financing standpoint and from an M&A standpoint, how does that look like?
So the question is, in 2012, from a deal standpoint and M&A standpoint, what does the year look like?
I talked to a guy the other day, and I don't know if these numbers are true. He said there's $500 billion of cash on corporate America balance sheets and $500 billion of cash in private equity funds. So a tremendous amount of liquidity out there. So that would argue it's going to be a very good year. I mentioned the tax change going up at the end of this year for capital gains. That would argue it's going to be a very good year. On the other hand, the world is a tremendous, cauldron of uncertainty, whether you want to talk about Sacramento or Washington or Europe or whatever. So the economy is very uncertain. There's never a perfect time, but and business is, if you have a good business, I guess I would say if you have a good business with good sales, good earnings, and a good track record, I think this is probably a pretty good year, relatively speaking. I'd be interested to hear what everybody else thinks.
Kip, do you want to go on?
I think, yes, on the liquidity. I think in the venture community, we've been going now, I think it's 7 or 8 quarters in a row where the venture industry in the US has been investing more money than it's been raising. So that is not a sustainable model. I don't know where that's going to wind up. Venture early stage money is still very hard to come by. It's, I think, in part because the funds that can raise new funds, or the venture firms that can raise new funds, will tend to put larger amounts of dollars to work in later stage deals. It's going to be quicker to exit. They won't have the huge returns that they might have expected earlier in the venture days, but they won't have the risk either, or less risk. So early stage money on the equity side is hard to find.
I think for a lot of venture companies, it used to be the end of the rainbow is going public, and the multiples and the prices you get for going public, and smaller companies used to go public. The cost of being public, the problems of going public has screened out kind of a whole tier of kind of smaller companies. So their exit now is selling to some other kind of strategic buyer. So,
at least my purvey, we touch multiple points here at the bank is, on the PE side, the team that deals with the LBO financing, we've seen it strong right out of the gate on that side. I think as we look across some of the tech verticals, you see some of them where it's about vertical integration and bringing that up. But you kind of look into the digital advertising space where there's I think a lot of them view that okay, between the publisher and the disaggregation, there's an opportunity for adjacent markets to pull those together as well. I think with the software market, because of the recurring revenue nature, there's a lot more interest around those as well. I think, Kip raised the point, if you look in kind of a hardware space, I think last year there was, 2 or 3, new semi-chip startups funded, so it was very limited on that side as well.
But went out of business.
Yeah, and then where we've seen activity, a lot of our clients who are flush with cash or have strong P&Ls, clearly are putting in place acquisition lines to take a chance to grow the business. But we've seen that opportunity looking into Europe as well. But with the situation in Europe, people are being very cautious about what they buy, over on that side as well. So, I would say from the financing side, it's positive out of the chute. In all the years I've done this year over year, I say we've come out of the chute stronger from a debt perspective, just pace of activity. But it's not uncommon in the banking industry where it's a new year, allocations free up on that side. It's usually the end of the year where sometimes in the banks they'll say they manage it by segment, saying we're full in this segment, we're going to wait off. But you look at the rate environment where we are. I think there's another forecast that we're out to 14 without a rate increase. So it is cheap money when you look at that.
One thing I think a lot of big companies during the downturn in the economy have cut a tremendous amount of their internal costs. And so, including new products and R&D and that sort of thing. So they look for acquisitions oftentimes for a source of growth, because they just don't have that internally anymore.
And I think it's still predominantly a buyer's market, and of the 2 major human influencers, fear and greed. I think that it's getting into better balance, but there's still probably more fear out there than I'd like to see. So I think that's still an overhang on the market.
Yes, Stephanie.
Jessica, could you probably speak a little bit more also about the international aspects you were mentioning earlier, deals you were doing with companies in Europe, and we have an audience that's very international, so probably there are some certain aspects that you would like to mention about that.
Yeah, I mean, certainly from the perspective of our European clients, they're just being more cautious. Like Mark said, that feeling of uncertainty. I think the macroeconomic climate in Europe is affecting their desire to go out there and acquire and grow. I think they're waiting to see what's going to happen on a macroeconomic level before they make a big leap, like go out and acquire a company. but certainly our experts can speak to that as well. I know Mark has worked on international deals.
I represented a company in Seattle that sold to a company based in Wales, and there at least there was a common language, although the legal aspects of the transaction were very different. The problem, if you're buying a company in the U.S. And you're in Europe, it's very hard to be comfortable with a management team if you're too far away. What we see better is if it's an add-on. If you're a European company, you have some U.S. operations, and you can look at acquisitions to add on. But that first one of getting your toe in the water is important because if you want to get into the U.S. market. But if you don't know the management team already, or have a partnership with them already, or some relationship, getting over that kind of will we work together well is an issue. I've talked to a few groups from China that have come in, and I keep waiting for this, mythical Chinese buyers, like the mythical Saudi buyer we had in the past. And I haven't seen it. I haven't seen it materialize yet. We keep hearing that there's a lot of cash looking for havens in the United States, but I see it going more into real estate than into companies.
The one thing that I think to keep in mind is U.S. buyers acquiring companies in Europe. When you're looking to try to leverage or finance that revenue stream over there. There's things you have to worry about, with deemed dividends under Section 956. And you can't take guarantees back to the U.S. entity. You can avoid it with stock pledges, but for the lender, it's going to be okay. How do we try to create two collateral pools around that? So, as you look to buy companies overseas, you've got a revenue stream where you're billing and collecting. If you want to, have this tax shield, it does pose a challenge for the lenders when it goes into the structural side, because we've got to make sure we don't tip you outside from the deemed dividend under 956. So that's just the nature of going global. We see this with all our clients. There's ways of kind of getting around it, but it's kind of a little bit of a minefield, and it kind of goes back to having proper advisors guiding you through that.
We had a guy looking at a French company, and the rules of changing your employees at that time, it was a couple of years ago, but you couldn't lay people off, you couldn't downsize, you couldn't reorganize because of the French employment law. So he was kind of scared off and ultimately didn't do the deal because of that. So there is a lot of cross-border value because if you have a product from one country, you want to bring it to another country, but it's more complicated, I guess I would say, the bottom line. We've done some, but they're more complicated.
Yeah, we've noticed that actually with a lot of our clients that are trying to attract VC funding here. If they're based over in Europe, the best way to do it is actually form a subsidiary here in the U.S. and then make sure all of the IP is here, so everything valuable is within the U.S. entity. And that just makes a lot of the investors feel more comfortable. They're dealing with the U.S. entity. It's predictable what type of laws that they're going to encounter. They know all the value is in the U.S. And so you have a much better chance of having of attracting investors or an acquirer if you actually have a U.S. presence.
Actually, to speak to that, I've got a client that should, between now and the 31st, be closing his A round, about $2.5 million. This is a company whose engineering start is in India. They've created a U.S. company that is now the parent of the Indian company. It's the U.S. company that's getting the financing, but from two Indian venture funds.
Okay, yeah.
And it's complicated.
Great. Yes?
Have you participated in an auction, buy or sell, where both buyer or seller are blinded?
What was the last part? Or both?
Either both buyer or seller are blinded. Neither party knows who they're dealing with until the end.
I have participated in auctions, but not.
I think many people didn't hear that.
Yeah, so the question was whether anyone here had participated in an auction where both the buyer and the seller were blinded.
I haven't. I've participated in auctions and run auctions where we were representing the seller, but everybody knows. In my experience, that would be very hard because there's comparing company A and company B when we're representing sellers. It's not just the money. There's a lot of other intangible things about which company they prefer. Sometimes people choose a lesser value because of other intangibles, like they like this company better, they think it'll treat their employees better, things like that. So who the buyers are is very important to them. So I've never seen that.
That sounds a little bit like the dating game.
I want to sell a company, you know, like that. I can put whatever numbers, right? I can present whatever. If you don't know who I am and you cannot do due diligence, I don't think it's a realistic scenario. Am I right?
We have one, actually I'm working right now, where the client is very concerned about his name being out there. So we prepared an offering memo that doesn't have the name of the company in it. In this particular industry, knowing the name of the company wouldn't really matter, but he's concerned about the name of his company. So I've done that, but we sign a confidentiality agreement, and then the buyers want to know who is this, and they want to meet the people and know who they're dealing with, and vice versa. So.
Great. Well, thank you so much for coming out this evening, and I hope this was insightful for you. Our goal was to give you a sense of what acquirers are looking for, and also let you know a little bit about the due diligence process. And if you are in the middle of an acquisition, to get the advice that you need so that you don't land in one of the pitfalls that could end up with you taking a haircut on the price. So thank you again for coming.